First up, your salary's hidden layers. We've got to look beyond just that monthly paycheck.
You know, a lot of your salary isn't really meant for your monthly bills. It's actually designed as an automatic savings plan. It's like a built-in safety net, a retirement fund that's just quietly growing in the background, building up your financial security without you even having to think about it.
All right, let's talk about the real powerhouse of your long-term savings, the Provident Fund. Seriously, for most of us, this thing is the absolute cornerstone of building a comfy retirement.
So what is it? Think of it like a special savings chest that's locked until you retire. Every single month, a slice of your salary goes in, and here's the best part. Your employer puts in money too. And over the years, with interest and all that, this thing can grow into a really, really substantial nest egg.
And this is where the magic really kicks in. Your PF account grows in 4 different ways at once. You've got your contribution, your employer's contribution, the interest you earn on your money, and the interest you earn on their money. It's a compounding machine.
Okay, so not all PF accounts are the same. You've got 4 main types. Government folks, you've got a statutory PF. If you're self-employed or want to save extra, there's the Public Provident Fund, the PPF. But for most of us in the private sector, it's going to be one of 2, a recognized or an unrecognized PF. And listen up, because the difference between those two, it is a huge deal when it comes to your taxes.
So let's zero in on the Recognized Provident Fund, the RPF, since that's what most salaried people have. The tax rules for this are super specific, and you're going to want to know them to get the most out of it.
Okay, first magic number to remember, 12%. As long as your employer's contribution is 12% of your salary or less, it's completely tax-free for you. If they contribute more than that, which would be awesome by the way, that extra bit gets added to your taxable income.
And the second number you need to know is 9.5%. The interest your PF balance earns is tax-free as long as the interest rate is 9.5% or lower. If you're lucky enough to get a higher rate, any interest above that 9.5% mark becomes taxable.
Now, this is why that word recognized is so important. With an RPF, if you've worked for more than 5 continuous years, that entire mountain of cash you've saved up, it's tax-free when you withdraw it. But with an unrecognized PF, oof, your employer's contributions and all the interest you earned suddenly become taxable. The difference is absolutely massive.
This little decision tree makes it super simple. See that 5-year rule? That's the big one. If you've put in 5 continuous years of service, boom, you're good to go. It's tax-free. If you leave before that, it gets a little tricky. But there are exceptions, like if you had to leave because of bad health, or if the company shut down, or, and this is a common one, if you just roll your PF balance over to your new job. In those cases, you're still in the clear.
7,50,000 rupees. This is the magic number. You've got to remember this one. If your employer's total contribution for the year to all your retirement accounts, that's your Provident Fund, NPS, any superannuation fund, goes above this amount, then that extra bit is considered a taxable perquisite.
But wait, it doesn't just stop there. It's not just the extra contribution that gets taxed. The earnings on that extra amount, the interest or dividends it makes, that's also considered a taxable park. And that's where this formula, which looks a little intimidating at first, comes into play. Let's pull this formula apart so it actually makes sense. PC is just the amount your employer contributed over that 7.5 lakh limit for this year. Simple enough. R is the average rate of return your fund got. And PC1 and TP1 are super important. They stand for the excess contributions and taxable earnings from all the previous years. Why? Because this tax effect actually builds on itself year after year. Okay, let's look at a real-world example to make this concrete. So for this employee, the extra contribution was 27,600 rupees. The fund's rate of return was 11.1%. Now, since this is their first year dealing with this rule, we don't have to worry about that compounding part just yet. So the math gives us a taxable perk of 1,532 rupees. And remember, that's the tax on the earnings from the excess amount, not the excess amount itself. Okay, moving on to one of the biggest perks you can get, rent-free housing. If your employer puts a roof over your head, how do we figure out its value for tax purposes? For an unfurnished place, it's actually pretty straightforward. It's all based on a percentage of your salary, and that percentage depends on the population of the city you're in. For the big metros with over 40 lakh people, it's valued at 10% of your salary. For smaller cities, it drops down to 7.5% or even 5%.
But what if the place comes furnished? Well, you just add another layer to the calculation. You take that base value we just talked about, and you add on either 10% of the furniture's original cost each year, or if your employer is renting the furniture, you just add the actual rent they're paying for it.
So, when it comes to housing, it really just boils down to two main things. The population of your city sets the base percentage, and then whether or not the place is furnished adds to that value. Location and furniture, those are the keys.
Next up, another really common perk, the company car. If your job gives you a car that you also use for your personal errands, that benefit has a value that you've got to pay tax on. Let's see how that's calculated.
Personal trips and your employer is footing all the bills, the tax department makes it really simple. The taxable value is just a flat monthly amount. It's 1,800 rupees for a smaller car and 2,400 for a bigger one. And hey, if you get a chauffeur with it, you just tack on another 900 rupees a month.
Now for another chunk of cash you might get, your leave encashment. Yep, we're talking about getting paid for all those vacation days you never took. So this is basically a payout for your unavailed earned leave. But here's a little pro tip for you. If you can, wait until you retire to cash it in. Why? Because if you encash it while you're still working, the whole amount is fully taxable. But if you wait until retirement, you can get some really nice tax breaks. And when it comes to the tax rules at retirement, it's pretty different depending on who you work for. If you're a government employee, you've hit the jackpot. It's completely tax-free. For all the non-government folks out there, it's partially exempt, and we have to do a little bit of math to figure out how much. So, how do you figure out your tax exemption? It's actually pretty simple. You just have to calculate 4 different amounts, and your exemption is whichever one of them is the lowest. So we've got a fixed statutory limit, the actual cash you received, your average salary over 10 months, and the cash equivalent of your unused leave. Just find the smallest of those 4, and that's your tax-free amount. And that first one, the statutory limit? That's a big number. It's 25 lakh rupees. Now, one really important thing to remember is that this is a lifetime limit. So you'll want to keep that number in mind as you plan your finances over your career.
All right, we're almost at the finish line. Let's quickly touch on a couple of other big payouts that could come your way when you leave a job. These are the last few pieces of the puzzle.
First, there's retrenchment compensation. This is something you'd get if your job is terminated for certain reasons, like downsizing. Then there's the Voluntary Retirement Scheme, or VRS. This is when a company offers you a package to retire a little early.
And for both of these situations, the tax rule is pretty straightforward. You get a tax exemption of up to 5 lakh rupees. So the first 5 lakhs are on the house, tax-wise. Anything you get above that amount will be taxed.
All right, for the last big piece of this puzzle, we need to talk about the specified employee. This is a really important category because some of these perks we've been talking about, like the company car, are only taxable if you're considered a specified employee.
There are 3 simple questions, and if you answer yes to any one of them, then bingo, you're a specified employee. So first, are you a director? Second, do you own 20% or more of the company's voting stock? And third, is your salary, after a few deductions, more than 50,000 rupees a year? Yeah, with a threshold that low, pretty much every salaried professional is going to tick that third box.